If you're about to sign for a house or drive a new car off the lot before July 29th, hit pause right now. July 29th is the day the Federal Reserve makes a call that's already moving mortgage rates and car loan rates in your favor or against you, and most people don't even know this date exists. You've been watching rates creep up for months. You feel like the ground keeps shifting under you every time you check numbers online, and nobody's telling you why. Maybe you've been pre-approved for a mortgage and you're wondering if you should lock it in today or wait a couple weeks. Maybe you're staring at a car loan offer that feels way higher than what your buddy got last year, and you can't figure out why. You're not imagining it, and you're not bad with money. There's a real reason behind this, and it's happening right now, not next year. By the end of this video, you're going to know exactly what happens on July 29th, why it's messing with your mortgage and your car payment right now. And this is the part that matters most. So stick with me, the one move you can make either way that could save you real money, and it doesn't cost you a dime. Let's break down what's actually going on. The Federal Reserve meets 8 times a year to set the cost of borrowing in this country. Not the actual interest rate on your loan directly, but the base rate that every bank in America uses as their starting point. Think of it like the wholesale price banks pay to borrow money. When that goes up, they pass the extra cost right down to you. Their next meeting is a 2-day sit-down on July 28th and 29th, 2026, and the decision drops at 2 p.m. Eastern on July 29th, with Fed Chair Kevin Warsh doing a press conference right after at 2:30. If you look right here on the Fed's own calendar page, July 28th to 29th is locked in as an official FOMC meeting. This isn't a rumor. This isn't some finance influencer guessing it straight from the source. Right now, the Fed's key rate is sitting at 3.5% to 3.75%. It hasn't moved since December of 2025, and it held steady again at the last meeting in June. So on the surface, nothing's changed. But here's where it gets interesting, and where most people get caught off guard. At June's meeting, the Fed held rates steady, just like everyone expected, but they also released their forward-looking projections, basically each official's private guess of where rates land by year end. This is called the dot plot, and it flipped the script. Right here on the Fed's official page for the June meeting, you can see the projection materials laid out. Back in March, most officials were leaning toward one rate cut this year. That would have been good news for anybody borrowing money. By June, that flipped. The committee is now split straight down the middle. 9 of 18 officials pencil in at least one rate hike before the year is out, versus 9 who still see rates flat or lower. That's not a done deal either way. But it's a real shift toward what folks in finance call higher for longer. And it's driven by inflation, still running above the Fed's 2% target. Here's why that matters. Even though nothing official has happened yet, banks and lenders don't wait around for the actual decision. They price in what they think is coming. That's exactly why mortgage rates already started climbing after June's meeting, even though the Fed didn't touch the rate at all. Look at this right here from Freddie Mac's own weekly rate survey. The 30-year fixed averaged 6.49% for the week of July 9th. This is the exact source lenders themselves track every single week. If you're house hunting, this number is basically your monthly payment in disguise. A jump of even half a point on a typical home loan can add over $100 to your monthly payment. Easy. Here's a piece almost nobody's talking about, and I think it's a big deal. Back in April, the Fed's committee had a vote that split 8-4. You can see it right here on the Fed's official April meeting page. One member pushed for a rate cut, while 3 others pushed back hard against even hinting at future cuts. And according to PBS News' reporting on that meeting, shown right here on your screen, this was the most dissenting votes on the Fed's rate-setting committee in more than 3 decades. Read that again. That's not a rubber stamp room where everybody nods along anymore. That's a genuine fight over your money, happening behind closed doors. And when the people setting the rate can't agree with each other, banks and lenders price that uncertainty straight into what you get offered on a loan. That's not speculation on my part, that's just how lending works. Uncertainty costs you money. This isn't just a house thing. It's hitting car buyers just as hard, maybe harder if your credit's average. Right here from Bankrate's own weekly survey, new car loans are averaging 6.93% for a 60-month term. And if you're buying used, you could be looking at 11% or more. On a $30,000 car, a couple percentage points can mean thousands of extra dollars over the life of that loan. That's a family vacation. That's a semester of community college. That's real money leaving your pocket for nothing but bad timing. All right, let's get practical, because I'm not here to just scare you and leave you hanging. Step 1. If you're mortgage shopping, ask your lender about a float-down option or a short-term rate lock that lets you adjust if rates drop after July 29th. A lot of lenders offer this for free or for a small fee way cheaper than getting stuck with a bad number for the next 30 years. Step 2. For cars, don't finance through the dealership blind. Get pre-approved by your bank or credit union before you ever walk onto the lot. That gives you a number to compare against, so the dealer can't quietly mark you up without you noticing. And step 3, the one I really need you to hear, because this is the piece that actually decides whether you win or lose here. Don't try to perfectly time July 29th. I mean it. Nobody, not even the pros on Wall Street, can promise you what happens that day. The committee itself is split right down the middle. What you can control, starting today, is your credit score and your debt-to-income ratio walking in the door. A 40-point credit score bump can shave off more from your rate than any single Fed decision will. That's the lever that's fully in your hands, free of charge, and it works no matter which way July 29th goes. Look, I get it, watching rates bounce around while you're trying to make one of the biggest purchases of your life feels like being a sitting duck. But you're not powerless here. You now know the exact date, you know why rates are moving, and you know the one thing that's fully within your control, no matter what Kevin Warsh says on July 29th. So tell me, are you holding off on a house or a car until after July 29th, or are you buying regardless of what the Fed does? Drop it in the comments. I genuinely want to know what you're deciding and why.